Good afternoon, and welcome to the Voice of Wisdom. With over 60 years of experience as an investment banker, entrepreneur, investment analyst, economist, and venture capitalist, Morty Davis is Wall Street and capitalism personified. The over 400 companies for which he has raised more than $3 billion over the years have created a countless number of jobs and exciting new products. Through the Voice of Wisdom, Mr. Davis explores, analyzes, and debates the most topical, political, economic, and social issues facing our world today. Joining Mr. Davis today for a discussion on investing is Len Carter. Len is an experienced investment banker, private investor, and business consultant. And now, Mr. Davis and Mr. Carter.
Welcome back, my precious guests, my podcast partners. It must be Wednesday, 6:30. It's great to get together with you every week, 6:30 Wednesday. Tonight, I'm going to try to give you some of my wisdom. I hope I don't have too many arguments with Mr. Carter, a brilliant co-host tonight, over my views on investing. But I read a book some years ago called From Hard Knocks to Hot Stocks. It tells how I went from being destitute, really broke, more than broke, totally destitute, with 3 kids and just out of school, and then became, I don't want to give myself a kind of horror or a whammy, but I became very wealthy. I even made it to the Forbes 400 wealthiest. So I'm going to share some of my ideas about investing with you, some of the wisdom. It is, after all, this program is called The Voice of Wisdom, and having lived as long as I have, for sure I picked up some wisdom. Not enough, but a great deal of wisdom, thankfully. So I'm going to give you my ideas. And if you want to get all of my ideas and read an interesting book and kind of autobiography, I recommend you get it From Hard Knocks to Hot Stocks. Well, what are the things? What are some of the things that here's some of the praise that I got for this book. This is from Larry King. You may remember him. He passed away not long ago. He was on television for years and years and years. This is the book. This is the best book I've ever read on making it big. You're in the hands of a master. Enjoy. Then Donald Trump wrote the following. Morty Davis has written a chronicle of great triumphs. It is full of intriguing speculation and clear insights, provocative, challenging, and enlightening, and written by a unique man who really knows the score. A must read. And then one other one, there's several others, but Senator Bob Bull, who became majority leader of that Senate, he passed away as well. After reading From Hard Knocks to Hot Stocks, I know how Morty Davis made a fortune through smart, strategic investment. It's an only in America story about someone who succeeded the old-fashioned way. Morty earned success through hard work and determination, helping countless people realize their dreams along the way. Signed, Senator Bob Goodell. Okay. Carl Icahn just had one more, one of the great investors of our time. He wrote a very brief praise endorsement. There is much to be learned from this Morty Davis story. Signed, Carl Icahn, investor and financier. So let me start by telling you some of my secrets. First of all, in the book, I say that wives give it free. What does it mean, wives give it free? Wives, the men make the money, or historically, now the women make just as much. As a matter of fact, in tennis, at the U.S. Open, the women make more than the men, because they play only 2 sets, and they get the same prize money. The winner gets a couple of $1 million, just like the men get. And they only play for about 2 hours, and the men often play as much as 5 hours of hard work, hard athleticism, tennis. So wives traditionally are the ones that spend most of the money. The husbands bring home the money, hopefully, and the wives get to spend it. So when I say wives give it free, as they spend the money, they know the products they want to buy, the products that they love, the products that their kids love, the products that are selling, that are in vogue, and those are the stocks that do the best. So for the wives, just look at what you spend your money on, and then find out the name of the company that's producing that product and buy that stock. You don't have to be a genius or anything outstanding, just awareness. So be aware of, and I'll give you some of the examples. In recent years, some of the biggest winners have been the companies that produce video games, e-videos, e-games. And you could watch your kids, especially teenagers, but even older kids and younger kids. And those stocks have made a fortune for those that invested in them, because it's been an enormous growth field. Then if you're aware of your sons or your daughters' sneakers purchases, Nike is the number 1 sneaker producer in the world. And if you bought that stock, you'd be retiring with millions. And for example, just as another example, Tylenol. If you get some kind of ache or pain or headache, you take Tylenol. And you just check out the company that produces that. It's Johnson & Johnson. And it's been one of the biggest winners over many years. And then there's a great story. A friend of mine became very wealthy because he visited a friend of his, and he was his friend was watching a video, and he said, "Gee, I like that video. Where'd you get it?" And he says, "I got it from Netflix." He said, "What do you mean Netflix? What's Netflix?" He says, "Well, it's like Blockbuster, except they don't charge you." I used to get charged a lot of penalties, because if you keep it out for more than 1 day with Blockbuster, they charge you a penalty for every day that you keep it out. In the case of Netflix, you just tell them what video you want. They send it to you the next day, and you keep it as long as you want without any penalty. So he says, "That's terrific, because I pay a fortune to Blockbuster, because I'm always keeping it out weeks and weeks I forget to return it or I don't have time to return it. So he says, I bought the stock. I love the idea. I bought the stock and I made literally millions on that stock because it went from almost nothing to becoming one of the major entertainment companies in the world. Netflix, check it out. And it's a major streaming company. And incidentally, Netflix, the owner, this founder of Netflix, tried to sell the company to Blockbuster, and Blockbuster said, what do we need it? We're already selling millions and millions of videos at our stores, and people stop by and take whatever they want. So we don't need your mailing and getting it back from a client, from a customer. So they didn't buy it. As you may well recognize, Blockbuster disappeared. It went broke, while Netflix grew by infinite percentages over the years. Another product that you're familiar with, that you can watch your kids and even yourself enjoy, is Coca-Cola. And if you bought Coca-Cola, it's one of the number one holdings of Warren Buffett. Incidentally, one of my themes is the same as Warren Buffett's. Most people, when the market starts to go down sharply, they get scared. They think that it's the end of the world. They think they're going to lose all their money, and they rush to sell their positions, usually at a loss, often without a gain. They just want to get out because they're so frightened. And Buffett says every time there's a major downturn or a crash, a recession, and people sell their shares, he says, I feel like it's going to a market or a sales organization and buying everything at a big discount, sometimes as much as 50%, 75% or more. So he says, that's the opportunity for you to add at whatever position you like at a bargain price. So they don't announce bargains, they announce, oh my God, the market's terrible, it may go much lower, and the people that are on TV and all of the prognosticators, economic prognosticators and market prognosticators are given the message, oh my God, we don't know when it's going to end, it may be like 29 and so forth. So they frighten people out of their wits, and instead of adding to their position, they get rid of them. Another product that women are certainly aware of and their kids use and they themselves use are products that come from Colgate and Procter & Gamble, soaps and toothpastes and all sorts of creams and so forth. And if you bought those stocks, you would have made a fortune. Another one that is in your face, even if you're kosher, because in Israel they have kosher McDonald's, but McDonald's has been one of the fastest growing companies in the history of the country. And anybody that sees their kids loving hamburgers knows that they want to go to McDonald's. So if you bought McDonald's, you would have made a fortune. And it goes on and on. For example, one of the biggest gains occur where you spend your money. Where do you spend your money? Walmart, Costco, Target, Home Depot, dollar stores, Amazon for sure. Amazon is, you buy everything in the world on Amazon. And they also, some years ago, acquired Whole Foods, one of the great supermarket chains. So Amazon would have made you a literal fortune, you know, even $1,000 or $5,000 would have made you a multimillionaire. or Tiffany, the number one beloved jewelry company in the world. So just look at what you buy and how you spend your money, and how your kids spend their money, or how they ask you to buy them things that they love. You don't have to ask brokers. Brokers encourage you to trade. You should have patience. When you buy them, if you like them, stay with them. And if you really like them, you only need one winner in your lifetime. If you jumped onto Amazon early, buy more as it goes up. Buy ever more. Buy the new highs. Everybody likes to buy new lows because it sold at 40 and now it's only 12. My God, it's got to be a buy. But the movement of the stock itself tells you the story, that something's going on. If it's making a new high, it's either somebody's getting ready to buy the company, because there's always people that know inside information, lawyers and analysts and so forth. So if you buy the new highs, you get in the way of all of the takeovers before they happen, and also the real growth companies, like the iPhone, the iPad. That's been one of the biggest winners of any company. Or if you watch your kids on Facebook, that's been one of the biggest winners. You only need that one stock and keep adding to it as it rises. Don't sell it. The brokers encourage you to sell it. They like you to trade. They even have a motto. Bulls make money and bears make money. Bulls are the ones that are always optimistic, and bears are the ones that are often always pessimistic. But they say bulls make money and bears make money, but pigs don't make money. So by looking to make more money on your stock, they're accusing you of being a pig. It's the reverse of the truth. And if you listen to them, they'll have you trading and excited, in and out, different recommendations, and their title as brokers, stockbrokers, will make you broker than you ever anticipated. It's a proper, it's a perfect description of traders. Traders don't make money. Even the smartest traders rarely make money. So you got to have patience and pick a winner. And if you find somebody who makes good recommendations, like Warren Buffett, you could check his portfolio and buy what he's buying. You'll do well, but don't trade. Don't go in and out. People trade because I had one guy that traded. His wife screamed at him and yelled at him and so forth. He loved the excitement. He lost money all the time. Even when I gave him a good stock and I told him buy more, he right away sold it because he liked the excitement. And I'll tell you something else. He didn't even like if I made him money because he couldn't scream at me and yell at me, because he couldn't yell at his boss. He couldn't yell at his wife. So he paid a broker to trade. The broker made money, and he could beat up on the broker. So some of people really, it's hard to believe, prefer to lose money, or preferred if you lose money for them so they can beat up on you. So Facebook is owned by, today the name was changed to Meta. It's still a leader now in the newest field, artificial AI, artificial intelligence. So you would have owned all the greatest stocks, almost every great stock, if you just followed this theme. And also follow Buffett, who said, when it starts to crash, think of it, or the market starts to sell off sharply, think of it as a fire sale. You got a chance to buy things at a fire sale. I don't want to monopolize as I have been up to now, because I have a brilliant partner on today's podcast, Mr. At my age, I forget
Carter.
the names. Mr. Carter, who's, I shouldn't remember that because there used to be a famous product called Carter's Little Liver Pills. They did a lot of advertising. I forget if it was for your intestines or for your bowel movement, but anyway, it was very popular. Carter's Little Liver Pills. So here's Mr. Carter give you some of the pills that he knows about.
Tough pill to swallow. Well, let's talk a little bit about what you were saying, buying as a fire sale, because
Right.
if some people may be confused and think it's contradictory, because on one hand, Warren Buffett's saying when things go down, it's like a 50% off sale.
Right.
On the other hand, there's the expression, don't catch a falling knife, and sometimes things going down are going down for a reason, and it's not a fire sale, but a going out of business sale.
He's talking about the whole market. He's right as to you're right as to a given stock, because as I said, people love to buy new lows. If a stock was selling at 40 and you got a chance to buy it at 14, and the broker says, look, you can't lose money, the stock is telling you something. Usually if it's at 14, it's going to 6 or 5 or it's going broke. And if it's going up, it's telling you they're doing well and they're likely to do better.
Okay, so the key
So
point there.
when you're buying a stock that's making new lows, you're buying a falling knife.
So it's down. You can't just look at
Individual stock.
you can't just look at the price movement. You have to look at the price movement within the context of the market, because if the market is going down and the stock is going down, then it could be a sale, like Warren Buffett says.
Well, add to the position. He's saying add to the position that you like. He's not saying buy the new low because it's down. If you like Coca-Cola and now people are rushing to sell because they're frightened, that's your big opportunity.
So that begs the other big question is, when do you sell? How do you know when to sell? Because that's always, you may like a stock and it may be down, you still like it, and you continue to like it, because if you like some of these, even Home Depot was doing well, and then it was not doing well.
Well, I'll tell you, for the average...
That's always the hard part, is it going down and it's time to really sell and get out, or is it going down maybe temporarily?
That's a really good point, and that's why, for most people, I would recommend don't buy individual stocks. Here's what I would recommend, and it's a winner no matter what you do. Invest the same amount every week or every month or every quarter, whenever you get sufficient funds to invest. Invest the same amount, and you don't worry if the market's high or low. People are always trying to guess the market. It's impossible. Even the brightest people make terrible calls. Like what's his name said? Who was it? Samuelson or one of the great economists said.
Samuelson.
The
stock market predict.
Yeah, he said
predicted 9
economics. Yeah, economists predict that 9 out of the last 5 recessions or depressions.
And now it's 13 out of the last 7, because he said that in 1982, yeah. And it's been more predictions since then.
Economists are often wrong. They're very bright and they have all kind of good theories, but they're often wrong.
So why
is
that?
A perfect science.
Why isn't the market more correlated to the economy? Shouldn't it be?
No, the market is.
Why shouldn't? Why do you have a bear market but not a recession?
As I say in my book, it's much more. The market is much more susceptible to psychodynamics than economics, than what's currently happening. And if everybody gets scared at once, it starts to sell off, and everybody gets scared. That's when you have a crash, a recession, and they stop spending money because they're nervous, and even the banks stop lending money. So people act. That's what kills them the most. Kills investors the most is their psyche, their tendency, as we all have the tendency to worry. I'm going to lose all my money, my retirement, So, and the brokers like to even encourage them to sell, because if they sell, they make a commission on the sale, and then they make another commission on the way up. Even though right now you can trade commission free, but you're paying a price because your broker is selling that information, and the guy is making a fraction of a point on every sale or purchase. So it's costing you. That they're not working for nothing.
Or the broker's making the market.
Or the broker's making the market, yeah, in which case.
And you're buying and they're selling.
Right.
So that's always a difficult decision. I mean, look at 2020. Markets were down. 2022, last year, markets were down over 20% by last fall.
Right.
Everyone was saying there's a recession going to be in 2022.
Yeah, right.
And then when it didn't
Many
happen,
economists
they said, it's coming. It's just
Yeah.
going to be 2023.
Many
Then when it didn't come, they said, it's still coming. It's just going to be 2024. So now that the market's nearly back to all-time highs, people are saying it's still coming, but it's not here. So I don't know. I mean,
they do it on both sides. Like with inflation, when inflation starts, then they predict, oh my God, it's going to go through the roof. It's going to be. They scare people, and as a result of scaring people, people react. As I say, the psychodynamics is much more than the economic dynamics.
right. I mean, inflation is a lot self-fulfilling. When people think there's going to be inflation, they run out buy, and that causes inflation, and they think there's going to be more inflation. Those are the expectations. I guess similarly with bull and bear markets, when people start to buy and everyone starts to buy and prices go up, it's like, oh, they're going up, I need to buy, and now I'm going to.
And when everybody's bullish,
a cycle.
That's a bad sign, because if everybody's bullish, they've already spent their money, they've already invested. When everybody's bearish, when I'm saying everybody, overwhelmingly bearish, that's a good time to buy, because they've acted on that, so they've sold their positions, and that's when you get the fire sale or the 50% off.
That's why the dollar.
Profit.
The dollar cost averaging approach, where you put the same dollar amount per period.
Yeah, you're
putting in the same dollar amount, so you're buying less when it's higher and more shares when it's lower.
You're buying less shares. You're buying fewer shares at the higher price and more shares at the lower price. And over the years, if you average out, if it's still the same as when you began, you'd be way, way ahead. So that's the safest way for investors to invest. Buy the.
And since you're
what's the biggest one? The
S&P 500.
The
maybe?
Vanguard fund,
Yeah.
or the S&P Standard & Poor's index. One where you don't have to make any decisions. You're buying all the stocks in the big stocks in the stock market, and it's not a gamble. They're not buying the lowest price. You're not going to make the home runs that you could make on a low price stock that goes from $2 to $20 or even higher.
Yeah.
But you're going to make a lot of money over the years.
The reason I like that approach for young investors in particular, because the index, to your point of, you want to buy companies that are doing well and continue to own them. The index automatically gets rid of companies that are doing poorly and going down out of business, and adding companies that are doing well. And so as an investor, if you owned Kodak, which was part of the Dow, you wouldn't have to sit there and think, here's my 30 stocks in the Dow. Is it time to, do I keep, which ones do I get rid of and which ones do I add of my 30?
Yeah. If you remember,
Automatic.
If you remember, Kodak was one of the top stocks in the United States stock market for years and years, because everybody was buying film and camera and projectors, and now it's nobody buys film anymore, projectors.
Bankrupt, yep.
I don't know, did it go bankrupt? Yeah. But it's still alive after bankruptcy.
Yeah,
but it's not a major company anymore. And the same with AT&T. It used to be everybody bought AT&T because they had a monopoly.
Yep.
And hey, how you doing? I was worried about you.
Appreciate it.
AT&T just hit 30-year lows.
Did it? AT&T, hear that? AT&T, that was the widows and orphans stocks. They said, buy AT&T, it's safe, there's no problem. It's gone, if you owned it the last 25 years, and you'd be a widow or an orphan just as a result of
owning the stock.
Of owning that stock.
Although the AT&T that you own today, symbol T, is a different company than the one back in the 70s, because it was it is still called that. But if you owned a share in '85 when they broke it up, today you'd have shares in all the different Baby Bells. So you would have done well. It's that AT&T that was after they broke up AT&T. The AT&T remained as just a long distance company.
Yeah, that's if you kept all of the spin-offs and everything.
Right, but if you sold off those pieces,
but the security was buying AT&T, right?
Then since the breakup,
and it paid a big dividend. And,
it's gone terrible.
Yeah, and it's true of so many of the major Dow components. When I came to the stock market, the hottest stocks were the
Nifty 50.
With the Nifty 50. They said, buy these, you'll never get in trouble as a broker because everybody's recommending them and you're not sticking your neck out or your reputation. And if you bought those, the copper stocks, the
Penn
steel
Central?
stocks, Penn Central and New York Central were both big stocks.
Until they weren't.
Yeah. So we live in a dynamic world, and I worked for a company in 1950, between 58 and 59, while I was at Harvard Business School, the summer job I had. And they had the company I worked for was Carlem Loeb Rhodes. It had the biggest research department on Wall Street because they serviced so many other brokerage firms. They cleared their business. They cleared their business means they handled their back office work. So as part of the attraction of clearing through them is they provided research services. One of the top researchers at that firm announced, in his view, that all the great companies that were ever established have already been established. There won't be any more. As a matter of fact, it goes back even farther. In 1899, the patent office said, we might as well close down because there won't be any more new patents. And there's more new patents in a week now than there were in a year in those days, or even longer, because we live in a very dynamic and high-tech society, and also with the internet, everybody learns what other people are doing throughout the world. Before the internet, there were guys at different universities all doing the same work, duplicative work. Now you get on the internet and you can find out all the latest doctorate theses. So you get the wisdom instantly, and since every new development depends on prior knowledge, prior technology, we're moving faster than ever into new fields and new developments, and so the internet is great. That's one of the reasons I say we should stay friendly with China, and they should stay friendly with us, because we learn from each other. Stop looking at competition as something terrible. We're just as violent in our approach as they are. We won't buy this great product that everybody else buys, a Chinese communication product, Huawei or something. What? Anyway, we told the British not to buy it. They bought it because it's a superior product. And we say, well, no, it's dangerous because the Chinese could get information off it and so forth. All day long, we're spying on them. They're spying on us. Every time somebody gets caught, they say, oh, no, he's not. I never saw one time when they catch somebody in the country and they say, we found them spying, and or they say, oh, yeah, you're right, you caught a spy. We always deny that he's a spy. So, we're not above it, they're not above it, and the best way is to work together so we can all move ahead.
Let's talk a little bit about information. You talk about the internet and how information availability, access to information has changed. Over the years, you've seen it, the pervasion, or perversion maybe, but pervasion of information. How has that changed? Like, when you were first investing in stocks, you didn't have the ability to, individuals didn't have the ability to go onto the SEC website and get 10Ks. You didn't have, all this availability of analyst reports. You
Absolutely.
didn't have any of that. So,
if anything, though, Len, if anything, it's more difficult than ever because there's so much information and so much reports every single day. If you spent all day long just reading the reports that come out from major corporations and analysts and economists and so forth, you'd be drowned and you wouldn't even know how to act because it's too overwhelming. So that's why I say wives give it free is the best way. Because, you miss the technology stocks, but you really don't. Because if you see your kid on Facebook, he's spending all day on Facebook, let me see if there's a stock or iPhone. You see everybody's buying an iPhone. You bought an iPhone or an iPad or everything with an I. iTunes, then you and the same with Amazon. So they have technology, but you're learning. You're not learning about the technology, and you're not buying it for the technology. You're buying it for the terrific end result that technology produces. So you won't get some major breakthrough of some technology, even though right now they're getting the benefit of artificial intelligence, even though few of us understand really what it is, because they bought Facebook, and Facebook turned into Meta, and Meta became a major artificial intelligence company. And Amazon has moved into everything. Amazon is a high-tech company today. They've developed so much new technologies.
So if information...
So you don't necessarily need to get information, and certainly technology information is only going to confuse you, because you don't know what the competition's got, what the Chinese got. But wives give it free. You're buying into what is, what you can see. And the minute you see they don't like it anymore, they're not buying it anymore, that's the time to sell it.
So would you...
That's a good point. The time to sell it is
yes,
when
your wife says...
When your wife says that
When you see
Your daughter-
when you don't see the credit card bills anymore.
Right, when your kids aren't doing it, or that, so far it hasn't happened. They're not buying iPhones anymore
Yeah.
or something.
And
But there are things that disappeared. There was a time when, what was the big one years ago? BlackBerry.
yeah,
Wasn't that the number
it
one?
was the handheld
yeah.
PDA device.
And then they stopped buying it. So who knew that first? The women who spend the money and the kids who who gave up on the BlackBerry and bought the iPhone or the Samsung, you know.
So do you think because of that oversupply of information, the deluge of information, do you think that's why it's so hard for even smart money managers to beat the index, to pick stocks
Yeah.
that beat
The mutual
indices? 'Cause-
funds overwhelmingly do not beat the. You'd think they would easily beat because they know everything that's in the index, and they could buy some that they know or that they think are going to do better. And overwhelmingly, there's a few great people or very talented people. There's a guy, Simmons, who makes $2 billion every year, but he's a genius. He's got an algorithm. He's got all geniuses working for him. And neither you or I, nor overwhelmingly the average person can compete with that. But even the brightest mutual fund managers, what they're good at is marketing their product, so they get new money all the time. But you're better off buying a Vanguard. Figured out that they don't have to choose, they don't have to hire analysts to pick stocks. They just buy the index. In other words, that's available. Everybody knows what it is,
Right.
and so you don't have to be a genius to make big money in the stock market if you do what I said. Wives give it free, or look at what Buffett's buying it because he's been a winner over the years, and he doesn't buy. He says he only buys companies that he feels are leaders in their field and generally essential. He loves Coca-Cola because he sees that people are hooked on it, and a lot of other basic companies. He's disappointed because a couple of times he's reached out and bought airlines, and the airlines over the years, as you'll read in my book, never make any money. They make a lot of money
Then they
when they're
lose a
doing
lot.
well, and then they go bankrupt and they lose a lot, and they go down to almost zero, and then the government bails them out, and then they run up again. So when they hit very low, you can buy them. When they go through their bankruptcy, you can buy them.
I thought it was. I guess maybe it wasn't Buffett. One of the big investment asset managers said, "Never ever own an airline."
Yeah, it's very hard to because they do tremendously well during certain periods, and then when it goes south, they do terrible. It's not even, moderate. It's always extremes.
Right. And you always say it's a lot. When the stock goes down 50%, you have to go up 100% to get back to where you were,
right.
and that's a taller order.
Much taller, right. So if it goes down 10% and you get out, you lost 10%, but you got a good chance to make 10% back. But to double your money to get even, that's a difficult. So I'm saying, stop trying to be a genius. Stop trying to do something that's unique or special, or pick individual stocks. The best thing is, and the easiest thing really, is put in the same amount of money if you get richer, then you could put in a larger amount each time.
I mean, to me, I think that's I agree that like the dirty little secret of investment management, I think, is that the managers don't outperform indexes,
Right.
and the big firms, have analysts and try to pick stocks, but at the end of the day, their business is more about asset gathering than it is about performance.
Right.
And their goal is to get assets under management so they can get a wrap fee of 1% or something and not lose clients' money because people are much more upset with losing money than they are upset with not making as much as they could have.
Their most successful dynamic or activity is convincing the vast public that they are experts and they will do better than you would. And in many cases they're right. Because if you pick individual stocks and you get a broker that's telling you trade in and out and this, he'll make a lot of money and you'll become broker at the end.
That's right. So that's why, to me, I think the issue's asset allocation as opposed to picking within the asset. For example, when you design your portfolio, the question I like to ask is not which equity should I own, but rather what percent of my portfolio should be in equity. What percent should be in the different asset classes. So what are the different asset classes? Maybe real estate is one, you can buy REITs. Fixed income is one, depending on your age, maybe you want to have some fixed income because...
I don't want to confuse people. I don't think they should choose different assets. The stock market is fabulous. You would have compounded your money tremendously if you followed the one thing that we just described. Put the same amount in every period, the same amount. You buy more at the top and less at the bottom, you'll do better than...
What about domestic index versus international index?
I just stick to... Don't try to be smarter than the rest of the world. Do the easy thing.
So don't buy the Europe 500 or any of those, index in Europe or Japan or any of those.
Then you're gambling on things
currency
beyond
risk.
your control, yeah.
What about an allocation between
also, they overthrow
stocks and
governments.
bonds? I mean, there's definitely an allocation. So you should think you should have 100% of your portfolio in stocks?
Yes.
No matter your age?
Yeah. Bonds go up and down too. Look, in recent years, bonds got killed.
Well, that's why I tell people to have a ladder. So you have bonds that mature in a year, 2 years, 3 years, 4 years, 5 years, and then
a ladder is dangerous. If you
good
fall off a ladder,
don't walk under a ladder. It's bad luck.
Right, and if you fall off a ladder, you get killed. Why do you have to be a genius?
What about cash? Cash is 5% now. Would you have any in cash?
Well, you should always have some cash in case of emergency, because you don't want to be forced to sell at a time when it's
But
not
what
a
about
good
if you
time to
use your
sell.
portfolio, if you're retired and you're using your portfolio to live on? Then you're going to have to sell at a downtime if you have...
Look, presumably when you're retired, you need less than when you're in your prime, and that's when you use the money and liquidate slowly. As you need the money, you liquidate. Don't try to play the market for sure at that age. Don't take risks.
Let's talk about risk. So you used to have the expression, there's risk and safety,
right,
and safety and risk.
Right.
So what do you mean by that?
Well, it's again...
How can you have risk and safety?
Because when you buy these risk stocks, when you buy the new high, say I'm recommending you buy a new high, right? You feel like the first idiot that ever paid this price, and if it goes down, you say, how could I have done that? But by buying that stock that's making new highs, you're less at risk than buying the ones that seem safe because they're making new lows and they keep going down. But whenever they're slow, so I'll buy it. And the stock is telling you the story, but there's no need for you to be, it's not your field, it's not your expertise. There's no need for you to study the stock market and to study the given stocks and so forth. Because it's very difficult, even the best people, we're saying even the experts that run mutual funds, their expertise is in marketing and in convincing people that turn over the money to us, we'll do better than, they like to say better than anybody, but if you look at, very few of them do better than the average without picking any stocks.
I guess also, if risk and safety, if you're too safe, you put it in the bank. Then you don't even earn inflation, and you're going to lose money. You're actually going to lose money by being too safe. Whereas
Right.
at least if you can tolerate volatility in the market over the long term, you're going to get a return in excess of inflation. So that's you're protecting yourself, and ironically, counterintuitively, by being safe, you're taking risk.
Yeah, well, we're just playing the statistics, the probability, the history. If you did just what I recommend right now, it's the least effort, and it's the most sure return. And you don't go to sleep worrying about it. You're putting in the same amount every month, every quarter, every week, whatever you're doing. And over time, if you look at it, whatever period of time, but you got to be patient, because over the short term, you could be a loser. Because if you just enter the market at the wrong time and it suddenly starts to go down, but you have to think of what Warren Buffett said. Every time it goes down, think of it as a bargain sale. You're getting more shares at the low price.
What I've told people to do, because there are people that, like you said, it's almost an addiction. So,
it is an addiction.
So for those people, take a little bit of your money just so that you can not go out of your own skin, and have a little bit of your money set aside for, just like you set aside, call it entertainment. You want to pick a few individual names that you think are high flyers, at least, and do it. At least they're getting it out of the system.
Yeah.
And do a little bit, but keep the 98% of your portfolio, 95% of your portfolio in this sort of approach. But at least just to take some of the edge off. It's like giving a recovering drug addict a little bit of drug.
One of my best friends that I grew up with, maybe my best friend at the time, became a stockbroker. So number one, he was a kind of idiot, because he called me up one day and he said, let's buy this stock and short it at the same time. He says, we can't lose money.
Can't lose.
We can't lose. But he didn't realize we can't make either.
We didn't tell you
But
that
he would get commissions. No, he was arguing with me.
Why that was a good idea?
Yeah. And I told him, don't you realize that if it goes up and I'm short means I sold it and I don't own it.
You cover the short with your own position.
Right. So I'm only out the commissions, and in the old days the commissions were pretty high. But then he got divorced, and his wife had all the money.
He tried that strategy on his wife, and she got wise to it, so she divorced
His
him.
wife had a business, and when he got divorced, she gave him money to leave cash.
Is that before the divorce?
So anyway,
He managed that?
No, so he was no longer a broker, but he was investing in the stock market.
He was no longer a husband either.
Yeah, he was picking stocks on his own. And by doing that, he thought he was going to be a genius, and he lost all his money. He actually ultimately joined not Alcoholics Anonymous, but Gamblers Anonymous, because what he was doing was gambling. He was thinking, I'll put it on this horse or on this stock, and it'll be a winner, and and very few were winners. And when he had a winner, he sold it too soon, so it was terrible. He went broke. He actually became a lecturer for
Investing Anonymous.
for Gamblers Anonymous.
Well, didn't you have a friend who had an
I used to
account
have
at a big firm?
I used to have a friend.
Yeah, who had an account at a big firm, and they lost most of his money and called him up and said,
Yeah.
"You have to
He
take
has
the
to take his
it's
account
not
out
big
because
enough."
it's too small for him to handle. Right.
That's beautiful.
That's Wall Street for you. You know,
They start with
turned over a big amount of money to them. They managed it.
Yeah, they
and
managed
they
it, all
managed it into the toilet. It got so low that they called them up. We don't handle
small account.
accounts this small. Right? Anyway, it's not a
That's
joke when you
classic.
lose your
Yeah,
money.
no, that's why.
If you have any questions, send me your questions, and I'll be glad to work with you on it. But start off by a cheap investment. Buy a copy of this book.
That's right.
From Hard Knocks to Hot Stocks. Even Donald Trump, whether you like him or not, in this case, made a good suggestion.
Yeah.
What did he say again? Donald Trump. Morty Davis has written a book of great triumphs. It is full of, you read it, because I don't have my glasses on.
Morty Davis has written a chronicle of great triumphs. It is full of intriguing speculation and clear insights, provocative, challenging, and enlightening, and written by a unique man who really knows the score. A must read.
And read the one by Larry King.
So Larry King, this is the best book I've ever read on making it big. You're in the hands of a master. Enjoy.
There's a bunch of other endorsements, but that's the best investment you can make. It costs very little, and you just take out the ideas that you find useful. But I'm telling you, the best ones, I meet friends at my tennis court, they just made a lot of money, they just bought this and that. And then another time they're very quiet because they didn't make any money. So they like that when things are good, they think they're geniuses and they're upbeat. And it's very counterproductive because it fools them that you can make a lot of money if you pick your own stocks.
But even that's why with the dollar cost averaging, it's a good psychological balance, because when the market's up, you feel good the market's up.
Yeah.
But when the market's down,
You're
you
buying
feel
at
good
a-
that you're buying low.
Right.
So it's
That's
a way to
right.
sort of keep yourself from going.
That's right.
From going nuts.
Buffett is a genius.
Yeah. All right. Thanks for having me, Morty.
Thank you. Is that time
Great
up?
It is. It is. We will, I'm sure, reconvene at some other time and another topic. But
It's always
been
great.
fun.
It's always great having you on. Like me, Mr. Carter is a Harvard Business School graduate. Like me, he was at the top of his class. So you know you're getting wisdom, good advice, or at least the best advice that's available to the average person. Even to the bright people. We both advise professionals. So take heed to what we're saying, and in the meantime, have a great week, every single day of your life. Each day should be better than the prior one. I love you, and I look forward to being with you next Wednesday at 6:30. Bye.